So what exactly is a stock? At its core, a stock is simply ownership in a business. When you buy a share of stock, you're literally buying a small piece of that company. Now, here's the thing. Understanding what a stock is, how stocks are valued, and how they fit into your retirement or brokerage accounts is the foundation of building wealth. And if you stick around, I'll explain everything you need to know about stocks, how they work, the difference between stocks, mutual funds, ETFs, and index funds, why most people are better off avoiding individual stock picking, and how you can use the S&P 500 to build long-term wealth. So let's start with the basics. A share of stock is simply ownership in a business. For example, if you buy one share of Apple, you own a tiny fraction of Apple itself. And here's the key idea. As Apple earns more money, grows, and becomes more valuable, your share in that business also becomes more valuable. That's why stock valuations are tied to company earnings, or the expectation of future earnings. This is why stock prices often move after earnings reports, major announcements, or big changes in the economy. At its core, the stock market is investors trying to figure out what businesses will be worth in the future. So how do you actually buy stocks? You need an account to hold them in. There are several options. A 401k is an employer-sponsored retirement plan. A traditional IRA or a Roth IRA are individual retirement accounts that come with different tax advantages. And a taxable brokerage account is a flexible, standard account where you can invest without contribution limits. The important thing to remember is this. The account you choose to invest in doesn't change what a stock is. It only changes how your investments are taxed. Now, let's quickly highlight how each one works. First, the 401k. It's offered by many employers, and one of the biggest perks is the company match. Some employers will match 50% to 100% of your contributions up to a limit, which is basically free money toward your retirement. Next, the IRA, an individual retirement account. There are two main flavors, traditional and Roth. With a traditional IRA, you contribute pre-tax dollars. That gives you a tax break today, but when you retire and withdraw the money, you'll pay ordinary income tax. With a Roth IRA, you contribute after-tax dollars. There's no immediate tax break, but in retirement, you can withdraw both your contributions and growth completely tax-free. That's the Roth advantage. Finally, there's the taxable brokerage account. Here there are no contribution limits, and you can access your money at any time. This flexibility makes it especially powerful for early retirement planning. It can act as a bridge account, helping you cover expenses before age 59 and a half, when you can access your 401k or IRA penalty-free. So remember, whether it's a 401k, an IRA, or a brokerage account, the main differences are in the tax treatment and any restrictions. Understanding that helps you decide not just what to invest in, but where to invest it. Now let's talk about the difference between stocks, ETF, mutual funds, and index funds. An individual stock is just one company. If you own Tesla, your performance depends entirely on Tesla. A mutual fund is a pool of many stocks chosen by a manager, often actively managed. An ETF or exchange-traded fund works similarly, but it trades on an exchange like a stock. And an index fund is a type of fund that simply tracks a specific market index, like the S&P 500. Think of it this way. Buying one stock is like betting on one player. Buying an index fund is like owning the entire team, or even the whole league. So why do index funds make sense for most people? Let's take the S&P 500 as an example. The S&P 500 includes 500 of the largest companies in the US, and historically, it has returned about 10% per year before inflation or about 7% after inflation. That means if you invest consistently in an index fund that tracks the S&P 500, you're effectively owning a slice of the entire US economy and letting compounding work over decades. And here's the kicker. Even most professional investors don't beat the market over the long run. If the pros can't consistently pick winning stocks, why should we expect the average investor to do it? That's why index funds are often the simplest, lowest-effort way to build long-term wealth. Now, you might be wondering, should you pick individual stocks? The truth is, it can be risky, so it depends on your personal risk tolerance. Buying one or two companies means you're putting all your eggs in just a few baskets. If those companies struggle, your portfolio suffers, and generally, you'll experience more volatility in your account balance over time owning individual stocks compared to index funds. On top of that, emotions get in the way. Most people end up buying high when stocks are popular, and selling low when fear sets in. That's why for most investors, individual stocks should only be a very small portion of their portfolio, if at all. The foundation should be broad, low-cost index funds. So how can you actually become a millionaire using stocks? It comes down to compound interest, the effect of your money earning returns, and those returns then earning returns of their own. Over time, compounding turns steady investing into serious wealth. Now, let's base this on a real rate of return of about 6.5% per year after inflation. Historically, the stock market has returned closer to 10% before inflation. But after accounting for inflation, the real return is closer to 6 to 7%. Here's what consistent investing looks like at different time horizons, assuming that 6.5% real return. Over 10 years, it would take investing nearly $6,000 a month to grow to over $1 million. Over 20 years, it takes about $2,000 a month. Over 30 years, only about $900 a month. And over 40 years, just a little over $400 a month could grow into $1 million portfolio. Now, you may actually see that account balance hit $1 million sooner if we use nominal returns around 10%. But here's the catch. Your dollar won't go nearly as far because inflation erodes your buying power over time. That's why looking at real returns is so important. It gives you a realistic picture of how your wealth will actually feel in the future. So let's bring this full circle. At the end of the day, a stock is simply ownership in a business. But investing doesn't have to mean guessing which businesses will win or lose. For most people, the smartest strategy is the simplest. Buy broad index funds, hold them for the long run, and let compounding do the heavy lifting. And that's everything you need to know about stocks, so you can start investing with confidence. I hope this video helped, and if it did, make sure to drop a like and subscribe for more financial content, so you can think through making financial decisions and win with your money, like a CPA.